Hi everyone, this is Sandeep Anand. It's that time of the year where we are trying to gather data and getting ready to file tax in many parts of the world. And 2020 might not be a bad year for most of us who have made, most of the investors globally has made a lot of money, and loss is not something we want to talk about. But point is today the topic is actually something called as capital losses, which can be useful when you file taxes to detect or to claim certain amount of losses that you had, which could offset your income by that percentage up to a certain limit. So capital losses detection lets an investor claim losses on the investments when filing tax returns, and it helps us to offset or detect a certain percentage of income. Now, the capital loss detection also helps an investor to come out of any wrong investment decision we would have made by selling them and booking losses. The point to be taken, if only it happens only when we incur losses after selling a particular stock or any other asset. And anyone can get this tax benefit from capital loss detections, and that will give us a small break from a bad investment decision. Now, to detect the stock market losses, we will have to fill out a form in US called 8949 and Schedule D for the tax return. Now, I've done it in India as well. It is possible to claim this deduction of capital losses in India as well, because recently, the capital gains concept came into India back in equities. Suppose I had booked a profit of 20K, $20,000 in a calendar year, and also realized $16,000 loss. It would offset. I mean, the gains is 20K, the losses is 16K. So net I have to report 4K profits. So thereby I'm reducing the total amount of gains which I have to report to. Suppose I didn't have any gains and I had only say 5K losses or 4K losses. I can claim those losses to get benefit from when I'm filing the income tax. Here are a few steps how to do it. Very simple process of calculating and arriving at the capital losses. I'm referring to the US markets. Suppose if you have more capital losses than you have gains for a given year, you can claim up to $3,000 of those losses and deduct them against other types of income, such as your wage or salary income. Now, if your net capital gains is more than the maximum amount, then you may, the net capital loss is more than the maximum amount of $3,000, then you can carry forward that to the next year. And there are certain number of years you can carry forward to. There is long-term and short-term capital gains, and losses for which 1 year is differentiating criteria. Now, first offset short-term capital gains and against the short-term capital losses. Similarly, long-term capital gains against long-term capital losses. If the net results are gains, then we report the commensurate, then we report and pay the commensurate tax amount. If net results are losses, then we can use them to detect the ordinary income up to $3,000 using the short-term losses first.